Imagine waking up, checking your portfolio, and realizing the spark for a global sell-off was a fight over buying Greenland. Not a bank collapse, not a war. An argument about who owns a giant icy island, with Trump putting tariffs on U.S. allies to force the issue. I'm Thomas Paul, this is the comment section, and today we're breaking down why Greenland just hit your stocks harder than half the companies in your watch list. Here's where things get interesting, because this isn't just some weird political sideshow. It's a live test of three big things that move markets: trade wars, rare earth minerals for AI, and trust in the U.S. dollar. So here's the setup. Starting February 1st, the U.S. is set to slap 10% tariffs on a bunch of European allies: Denmark, France, Germany, the U.K., and more. If there's no deal by June 1st, that jumps to 25%. The unofficial message? Work with us on Greenland, or your exports get more expensive. Now, tariffs are basically a tax on trade. Either companies eat the cost and make less profit, or they pass it on and you pay more for stuff. Both are bad for earnings, which is why markets freak out when tariffs show up in headlines. But it's even getting worse, because this isn't aimed at rivals like China. This is aimed at allies. And markets hate the idea that friendly countries could slide into a trade war over territory. So why Greenland? Why is this chunk of ice suddenly the main character of financial news? 3 reasons. First, national security. Greenland sits in a key spot between the U.S. and Russia and already hosts a U.S. military installation. Control of that location matters a lot in a world where Arctic routes and missile defense are back on the table. Second, rare earth minerals. Greenland has big, mostly untapped deposits of the stuff that powers electric vehicles, AI chips, and advanced electronics. If the U.S. had more direct access to that, it could reduce dependence on China for critical materials. And third, shipping. As ice melts, Arctic routes become more usable. Whoever controls those lanes controls a huge shortcut for global trade. And here's where things take a step further. When you mix strategic military base, AI-related minerals, and new trade routes, you're not just talking about land. You're talking about power. Long-term economic power. So Trump's playbook is basically use tariffs to force a negotiation where the U.S. gets some form of control or access to Greenland's strategic value. Not necessarily owning it outright, but having leverage. Now, how are markets reacting to all this? We're already seeing the classic fear trade pattern. Money moving into safe havens like gold and silver, volatility picking up, and investors suddenly Googling, what is a trade war again? For companies, tariffs mean higher input costs. A German car exported to the U.S. becomes more expensive. A French luxury brand gets squeezed. Pharma, manufacturing, autos, and luxury in Europe are in the direct line of fire. But then the unbelievable thing happened. Instead of the U.S. dollar strengthening on global fear, which is usually what happens, we're seeing concern about the dollar itself. Because if the U.S. is willing to threaten tariffs against its own allies over a territory deal, investors start asking, how stable is U.S. policy long-term? That kind of doubt doesn't usually crash markets overnight, but it does quietly shift where big money hides. Some flows try other currencies, some move into commodities, some just go to the sidelines and sit in cash. When I was about 12, I watched my parents lose most of their savings because they trusted a "don't worry, it's safe" pitch from a bank advisor. On the outside, life looked normal. At the dinner table, everything got very quiet. That's when I learned calm headlines can hide real pain. This Greenland story has the same feel. The headlines sound almost cartoonish. But underneath, you've got real risk to supply chains, to earnings, and to confidence in the system. But then he said this unbelievable thing. Trump basically laid out a phased ultimatum. 10% now, 25% later if there's no progress. That's not a random threat. It's a built-in countdown timer for volatility. For retail investors, that timer matters. Here's why. You've got 3 main paths this can take. Outcome 1. The U.S. actually buys Greenland outright. Legally and politically, that's very unlikely. Greenland's people in Denmark would have a big say, and this isn't the 1800s anymore. Land deals don't just happen because a superpower writes a check. Outcome 2. The more realistic one. The U.S. doesn't own Greenland, but increases control through expanded military presence, long-term leases, or resource agreements. Think, control without the PR disaster of a full purchase. Outcome 3. This whole thing fades within 1 to 6 months as a negotiation tactic. Tariffs get delayed, the rhetoric softens, and markets move on to the next crisis. Here's where things get interesting. The risk isn't just, do we buy Greenland or not? The big risk is escalation. If Europe hits back with counter tariffs, you get a repeat of the last trade war pattern. Companies delay investments, supply chains get messy, and stock prices swing on every podium speech. That's where safe haven assets and defensive sectors tend to shine. Historically, gold, high-quality bonds, and some defensive stocks like utilities and consumer staples get more attention in these moments. And in the background of all this, AI. Those rare earth minerals in Greenland matter because AI chips are insanely resource-intensive. If one country can secure more of that pipeline, it shapes who dominates AI hardware over the next decade. So when you see Greenland in a headline, read, long-term AI and EV bargaining chip. But in terms of my own plan for investing in this mess, let me walk you through it. In terms of how I plan to invest first, I'm not panic selling because of a tariff headline. When I worked part-time at a newspaper in college, I watched the same boring economic story get dressed up 3 different ways just by changing the headline. That's when I realized news is framing, not pure reality. So my approach is boring on purpose. Number 1, I assume tariffs and trade spats will come and go. So I keep a core portfolio in broad, diversified funds that don't live or die on one president, one island, or one quarter. Number 2, I separate headline risk from business risk. If a company's entire profit stream depends on European exports to the U.S., then yeah, I want to understand how a 10 to 25% tariff hits their margins. That might be a reason to trim or avoid, not because of drama, but because the math changes. Number 3, I don't chase safe havens after the first spike. If gold's already moved hard on fear, that's when I get cautious. The best time to think about hedging is usually before everyone's screaming about it, not at the peak of panic. So in terms of my own investments and how I plan to invest, here's what I'm doing. I keep my main strategy long-term and boring. I look at sectors that benefit from de-globalization and resource security, things like domestic infrastructure, certain commodity plays, or companies helping countries secure their own supply chains. And I hold a small slice of my portfolio for optionality, bets that benefit if this stuff escalates, without blowing up my future if I'm wrong. If you're watching this and thinking, this is cool, but there is no way I can keep up with every Greenland-style headline and still have a life, that's literally why this channel exists. This video was created with Fludge.io, the same system that powers this entire channel. If you've ever wanted to run a YouTube channel like this without being on camera, that's exactly what it's built for. It researches topics in your niche, writes a full script, builds thumbnails, uses an AI avatar, and uploads to YouTube automatically. Your job is to review, tweak what you want, and hit publish. You can jump in at any step, give feedback, and over time it learns your style. This isn't low-effort spam. The whole point is high-quality research content without you drowning in editing and production. If that sounds interesting, check out Fludge.io. But it's even getting worse because whether you ever use something like that or not, the bigger lesson here is this. The world is going to keep throwing Greenland-style curveballs at your portfolio. Tariffs, elections, resource fights, AI shocks. Your job isn't to predict every headline. Your job is to build a system that can survive them. Quick disclaimer before we wrap up, nothing in this video is financial advice. I'm not your financial advisor. I'm just a guy who watched his parents learn the hard way that, trust me, it'll be fine, is not a plan. Do your own research, and if you need real guidance, talk to a licensed professional. Now I want to hear from you. Do you think this Greenland standoff is a short-term bluff or the start of a much bigger realignment around resources and trade? And how, if at all, are you changing your investments because of it? Drop your take in the comments. I read as many as I can. If you found this breakdown helpful, hit like, share it with someone who keeps doom scrolling without context, and subscribe to the comment section with Thomas Paul for more calm, no BS looks at how politics and markets actually hit your money. Thanks for watching, and I'll see you in the next one.